Welcome to Chapter 8, Capital Gains and Capital Losses. In this lesson, we will discuss the tax treatment of capital gains and losses, which arise from the disposition of capital assets which were used to earn business income or property income. Now remember that the disposition of inventory assets are not considered a capital disposition. Okay, grab your textbook and let's get started. Flipping to the next slide, here we have the basic formula used to calculate capital gains and capital losses. The calculation is done by starting with the proceeds of disposition, the POD, and subtracting the adjusted cost base, ACB, and also subtracting any disposition cost. Now the proceeds of disposition may include other amounts in addition to the sales price of the property that is being sold. For example, the related proceeds from, let's say, an insurance policy on a damaged property that was sold would also be included in the proceeds of disposition amount. As well, the adjusted cost base of the property includes the original cost of the property, but there may be other amounts in the adjusted cost base as well. For example, if the taxpayer received any government grants or assistance towards the purchase of the asset, those amounts would also reduce the ACB of the property being sold. The resulting amount, the proceeds of disposition minus the ACB and also minus any disposition costs, if that amount is positive, that would be called a capital gain. If the resulting amount is negative, that would be called a capital loss. Now, only 50% of capital gains are taxable, and only 50% of capital losses are allowed. Therefore, the 50% amount of the capital gain is called the taxable capital gain, and the 50% amount of a capital loss is called the allowable capital loss. It's important to note that when there is a disposition of depreciable capital property or eligible capital property, there is never any capital loss realized. There could be a capital gain, but never a capital loss. Flipping slides, the next topic is superficial losses. A superficial loss occurs when a taxpayer disposes of capital property at a loss and within a 30-day period before or after the disposition, the taxpayer or an affiliated person, such as the taxpayer's spouse or common law partner, reacquires the same or identical property. The loss on the disposition is called a superficial loss and cannot be deducted. However, the loss is added to the adjusted cost base of the property that was reacquired. On the next slide now, let's take a look at an example of the application of the superficial loss rules. Read through the example and then calculate the adjusted cost base of the shares that were repurchased on January the 5th. Now pause the lecture now to complete the example and your solution before continuing on to the answer on the next slide. Okay, flipping slides, here we have the solution. When the shares are sold on December 20th, the capital loss is calculated. However, since the taxpayer repurchased identical shares within the 30-day period after the disposition, the capital loss is considered a superficial loss and is therefore not allowed. However, as shown here on the slide, the superficial loss then is added to the adjusted cost base of the repurchased shares, therefore increasing the adjusted cost base. Now at this point, do exercise 8-2 in your textbook on your own and then compare your solutions to the answer. This will help reinforce the superficial loss rules. Pause the lecture now to complete this exercise before moving on. On the next slide now, let's talk about identical properties and the rules with respect to identical properties. Now, this rule applies when, let's say, a taxpayer owns a group of identical properties that were acquired over a period of time at different cost. For example, a taxpayer may own shares in a public company and purchase those shares over a number of years at various prices. If some of those shares are disposed of, the identical property rules requires that the adjusted cost base for those shares being sold be based on the average cost of all shares that have been purchased to that date. Let's take a look at the example on the slide here. Read through this example and determine what the average cost per share is when the taxpayer sells the shares on December 20th. So pause the lecture now and work through the example before continuing to the next slide. Okay, here's the solution on the next slide. 100 shares were purchased at $15 per share, and then a further 200 shares were purchased for $20 per share. So the total cost is $5,500 divided by 300 shares, which equals an average cost of $18.33 per share. Now at this point in the lecture, do exercise 8-3 on your own. This exercise will reinforce the identical properties rule. So pause the lecture now, complete the exercise, and then continue on. Moving on, the next topic we will discuss is the capital gains reserve. This rule allows a taxpayer to deduct a reserve from the total capital gain when not all of the proceeds are received in the year of the sale. Now, remember the rule with all reserves that the taxpayer must add back the reserve in the following year's income, and then they can calculate a new reserve in that new year if one is eligible. Now, the reserve that is allowed under this capital gains reserve rule is limited to the lesser of two amounts, and the formula of those two amounts is shown here on the slide. Let's take a look at the second number first. The second amount here basically requires that a minimum of 20% of the gain must be recognized in the year of sale, and also a minimum of 20% in each of the following 4 years. However, when we look at the first amount here in the formula, the first amount here says that if the proceeds are collected faster than 20% per year, the reserve will be based on the actual amount of uncollected proceeds remaining. Let's practice the capital gains reserve rules with the example on the next slide here. Now read through the example here and then calculate for each of the 4 years the amount of the reserve allowed, if any, and also the amounts which would have to be included when calculating net income for tax purposes. Pause the lecture now to work through the calculations for each of the 4 years before continuing on. Okay, let's start with year 1 on the next slide here. Working through the reserve calculation, you see that the first calculation and the second calculation are the same, that being $40,000. Therefore, 80% of the capital gain is deferred in year 1. Only 20%, or $10,000, of the capital gain is recognized in year 1, and 50% of that, being $5,000, is the taxable capital gain. On the next slide now, we have the year 2 calculation. As shown here, we have to start off by adding back last year's reserve of $40,000. Then we get to calculate a new reserve for year 2. Again, using the lesser of formula, we calculate the new reserve for year 2 to be $30,000. Overall then, we have a net income inclusion of $10,000, of which, again, 50% is taxable because this is a capital gain. Moving on to year 3, we start off by adding back last year's reserve of $30,000. Then we calculate the new reserve for year 3. Now, working through the calculations, we arrive at a reserve of $20,000 for year 3. This results in a net income inclusion of $10,000 of the capital gain, of which again 50% is taxable. Now, I want to point out again that the way the lesser of formula works is that a minimum of 20% of the gain must be recognized in the year of sale and in each of the following 4 years. This is what we have seen for years 1, 2, and 3. Now keep in mind that if the proceeds are collected faster than 20% per year, then the capital gain recognition will be more than 20% per year. What this also means is that no reserve would be available after the end of the 5-year period, even if there are still uncollected proceeds. Let's go to the next slide now and look at year 4, the year in which the remaining proceeds are collected. After we add back last year's reserve of $20,000, we work through the lesser of calculation. In the first calculation, because there are no more proceeds outstanding, no reserve would be available. Therefore, the remaining 40% of the total capital gain, that being $20,000, is included in income. Again, only 50% is taxable, resulting in a taxable capital gain of $10,000 in year 4. At this point in the lecture, do exercise 8-5 on your own and check your answer before moving on in the lecture. So pause the lecture now to complete that exercise. On the next slide now, let's move on to the next topic. Special tax rules with respect to the sale of real property. When we talk about real property, we're basically talking about land and the building on top of the land. Usually the sale of land and building is made for one price, and some estimation is required to determine what amount of the sales price should be allocated to the land and what amount of the sales price should be allocated to the building. Now, without any special tax rules in place, there could be an incentive to allocate a larger amount to the land, which would create or increase a capital gain, of which only 50% is taxable, and therefore there would be a lesser amount allocated to the building. And because the building is a depreciable asset, that could potentially create a fully deductible terminal loss. The way the tax rules work is to limit the amount of any terminal loss which might result on the disposition of real property. Basically, some of the proceeds from the land are reallocated to the building to reduce the terminal loss on the building by an amount up to the potential capital gain on the land. Moving on to the next slide, here is an example of this rule. Pause the lecture at any point to review the facts before continuing on with this example. Looking at the example here, if there were no special rules in place, there was no subsection 1321.1 in place, what we see here is that there would be a terminal loss of $10,000 on the building and a capital gain of $35,000 on the land, of which only 50% is taxable. Moving on to the application of the special rule subsection 1321.1, by applying this rule, $10,000 of the proceeds from the land is reallocated to the building. The land proceeds then decrease from $75,000 to $65,000, while the building proceeds increase from $50,000 to $60,000. Now this completely eliminates the terminal loss on the building and also reduces the capital gain on the land. Now in your textbook there's a full example provided of the application of this rule along with the solution. So pause the lecture now to work through that textbook example. As well, exercise 8-7 is good practice for the application of this rule as well. So pause the lecture now to work through these examples and exercises before moving on in the lecture. On the next slide now, let's move to the topic of principal residence and the tax rule which allows for a reduction to any capital gains realized on the sale of one's principal residence. Now for most taxpayers, any capital gains realized on the disposition of a principal residence is free of tax. I should point out that in any particular year, only one taxpayer within a family unit is allowed to designate a property as a principal resident. A family unit is considered to include the taxpayer's spouse or common law partner, and any children, unless the child is married or in a common law relationship, or if the child is over 18 during that particular year. Now, technically, the capital gain on the disposition of a principal residence is taxable, and then the gain reduction formula, as shown here on the slide, is used to reduce the gain to the appropriate amount. In the formula, you will notice that the taxpayer must designate the number of years this particular property is deemed to be the taxpayer's principal residence. This is usually only relevant when the taxpayer owns more than one property in any particular year that could qualify as a principal residence. In such situations, the taxpayer must decide for each year where more than one such property is owned, which property then to designate as a principal residence for each year. Now, let's go through an example. Let's say that we have a taxpayer named Elsie, and she owns a condominium in the city where she works, and also a cottage in the countryside where she spends most of her weekends and holidays. Now, both of these properties would qualify as a principal residence. However, she is only allowed to designate one property per year as her principal residence. Let's say when Elsie retires, she decides to sell both properties and move in with her daughter. If there is a capital gain on the disposition of both properties, Elsie should then calculate the average capital gain per year on each property. And then the larger amount of capital gain per year should be the one that she designated as her principal residence, as that will shelter the larger capital gain amount to be free of tax. And the property with the lower average capital gain per year then would be subject to tax. Now, exercise 8-9 in your textbook is good practice, so do that exercise now and review your solution before moving on. What I've also done as well is I've worked through assignment problem 8-7, and I created a step-by-step document going through that assignment problem, and I will post that solution on Moodle for you to review. So check Moodle for that particular assignment problem and work through that together with the solution to make sure you understand how these principal resident rules work. On the next slide now, we're going to talk about two different types of capital property, and each one has a separate set of rules. One property category is called personal use property, which is basically property that is held by the taxpayer for personal use and enjoyment. The next category is called listed personal property, which is basically a subset of personal use property. Now, listed personal property is specifically listed in the Income Tax Act as art, jewelry, rare books, manuscripts, stamps, and coins. Now, generally, these types of property, these listed personal property, has the potential to appreciate in value. Moving on to the next slide, with respect to personal use property, losses are deemed to be nil. Therefore, they're never deductible. So losses on personal use property are never allowed. Most personal use property would depreciate over time. So therefore, when one disposes of personal use property, the majority of the time it would be at a loss. Only gains on the disposition of personal use property would be realized for tax purposes. Now, a further rule with respect to personal use property is that the proceeds of disposition is deemed to be the greater of the actual proceeds and $1,000. As well, the adjusted cost base is deemed to be the greater of the actual adjusted cost base and $1,000. This minimum $1,000 rule means that gains on smaller value personal use property items will not be taxable. Moving on to listed personal property, the minimum $1,000 floor rule also applies to the proceeds of disposition and also the adjusted cost base. Furthermore, there is a restriction that allowable capital losses on listed personal property dispositions may only be deducted against taxable capital gains on listed personal properties. As noted on the slide here, such allowable capital losses on listed personal property may be carried back 3 years and carry forward 7 years. Now, work through exercise 8-10 in your textbook at this point to reinforce these rules with respect to personal use property and also listed personal property. So pause the lecture now to work through this exercise before continuing on. Flipping slides, we're now going to switch our discussion to the change in use rules. The basic premise here is that when a property is used to produce income, is converted to some other use, let's say personal use, or conversely, when the opposite happens, when a property was held for personal use and then was converted into business use, there's a deemed disposition for tax purposes. And this deemed disposition is said to take place at fair market value. So let's review the two common scenarios where these change in use property rules would apply. The first scenario is where an income producing asset is converted to personal use. So it was used for, let's say, in the taxpayer's business, and now it's converted into personal use. The fair market value is deemed to be the proceeds of disposition from the business perspective and also the capital costs of the acquired asset for personal use. So that's pretty straightforward. The fair market value would be used for both the proceeds of disposition to determine if there's any capital gain or capital loss, and also the fair market value would be used as the capital cost in the hands of the taxpayer when it was converted into personal use. Flipping slides, let's take a look at the second scenario, which is a bit more complex. In this scenario, an asset is used personally and then converted into an income-producing asset, for example, for business use. So we have an asset used personally, and then it was converted into a business use asset. Now, in this situation, we look at whether or not the fair market value was below the original cost, or if the fair market value at the time of conversion is above the original cost. If the fair market value is less than the cost, then the fair market value will be both the proceeds of disposition and also the capital cost of the asset acquired for business use. That again is pretty straightforward. However, if the fair market value is greater than the original cost, the fair market value will still be used as the proceeds of disposition, which will result in a capital gain. However, for CCA purposes, the capital cost of the asset acquired for business use will be equal to the original cost plus 1/2 of the capital gain realized on the deemed disposition. Now, the reason for this rule is to ensure that only the portion of the gain that had been taxed, that is the 50% portion, would be eligible for CCA deductions in the hands of the business. Another complication is that for capital gains purposes, the capital cost of the asset in the hands of the business would be equal to its full fair market value. It might be easier to look at an example. So take a look at this example on the slide here pause the lecture now to read the facts first before we continue discussing this example. Okay, so what do we have here? The boat was acquired originally for $200,000, and at the time that it was converted from personal use to business use, the fair market value was $300,000. So the fair market value is greater than the cost. Now there's a deemed disposition at fair market value. Therefore, the taxpayer has a capital gain of $100,000, of which 50% is taxable. Therefore, the taxable capital gain is $50,000. Now, in the hands of the business, the boat's capital cost for CCA purposes and for capital gains purposes will be different. For CCA purposes, the capital cost will be the original cost of $200,000 plus 1/2 of the gain, which is the taxable portion of $50,000. Therefore, the capital cost for CCA purposes will be $250,000. Remember, this rule was put in place to ensure that the business does not get CCA deductions on the 50% of the capital gain that was not taxed on the deemed disposition. However, for capital gains purposes, when the business, let's say, sells the boat in the future, the capital cost is the fair market value of $300,000. Now, in your textbook, there's a good example illustrating these rules and also working through the solution with you. So ensure you review this example before moving on in this lecture. On the next slide now, let's talk about an election that is discussed with respect to subsection 45(2). This election is often considered when a taxpayer changes the use of his or her principal residence from being used as a home into, let's say, a rental property. This election, if made, would allow the taxpayer to continue to designate this property as a principal residence for up to 4 additional years, even though it's being used as a rental property. Now, this election would be of importance to a taxpayer that, let's say, decides to, rather than buy a new home after they move out of their original home, to, let's say, rent a home after moving out. If the taxpayer decides to, let's say, rent a home after they move out of their original home, then they won't have another property to designate as their principal residence. And therefore, this election would be of importance to them because they could designate the now rental property as their principal residence for an additional 4 years. And that could help to reduce or eliminate any capital gains that accrued during those additional 4 years. It's important to note that if the taxpayer files this election, no capital cost allowance may be taken on the now rental property. The taxpayer must still report rental income and will be allowed to deduct all associated rental expenses, just not able to deduct any CCA. On the next slide now, the opposite scenario may also happen, where the taxpayer has a rental property and later decides to move into the rental property and make it his or her home. There is an election which may be filed under subsection 45(3), which allows the taxpayer to retroactively deem the rental property as his or her principal residence for up to 4 years prior to moving into that property. Now, there are 2 exercises in your textbook which illustrates these elections. At this point, work through exercise 8.13 and also 8.14 and review your solutions before moving on. So pause the lecture now to do these 2 exercises. Flipping slides, let's move on to the next topic about deferral provisions on small business investments. This deferral provision is in place to encourage small business investments by providing a deferral on the recognition of any gains realized on the disposition of eligible small business corporation shares, provided there's a subsequent purchase of shares in another eligible small business corporation within a specified amount of time. Let's first talk about what is an eligible small business corporation. Well, an eligible small business corporation is a CCPC where 1. Greater than 90% of the fair market value of the assets are used to carry on an active business in Canada, and 2. The carrying value of the corporation's assets is not in excess of $50 million. So both of those conditions have to be met for this CCPC in order for it to be classified as an eligible small business corporation. So now we know what constitutes an eligible small business corporation. In addition to that, the disposition of these shares must be a qualifying disposition. What that means is that the disposition must be of common shares of an eligible small business corporation, and the taxpayer selling the shares must have continuously owned those shares for the 185-day period prior to the disposition. On the next slide now, in order for the deferral provision to apply, the taxpayer must also purchase new shares of an eligible small business corporation within 120 days from the end of the taxation year in which the disposition took place. Now, these new shares that are acquired must be designated by the taxpayer as being replacement shares for the shares that were sold. Now, provided all these conditions are met and there was a gain on the qualifying disposition, part or all of the gain may be deferred and subtracted from the adjusted cost base of the new replacement shares. The amount of the gain which is allowed to be deferred is calculated by using the formula as shown here on the slide. So the gain is multiplied by the fraction of the numerator, which is the lesser of the adjusted cost base of the new replacement shares, and the proceeds of disposition of the old shares which were sold, so the lesser of those two amounts, over the denominator, which is the proceeds of disposition of the old shares. Now, this fraction cannot exceed 1. Basically, what this means is that as long as the adjusted cost base of the new replacement shares are equal to or greater than the proceeds of disposition of the old shares, the entire gain will be deferred. Once again, looking at the last bullet point here, the deferred gain is subtracted from the adjusted cost base of the new replacement shares. On the next slide now, here is an exercise that we'll work through to help better understand these deferral rules on small business investments. Read through the example and work on answering the 3 questions at the bottom of the slide. Calculate the gain on the qualifying disposition, then apply the formula to determine the permitted deferral, and finally calculate the adjusted cost base on the new replacement shares. So pause the lecture now to work through this exercise. Okay, on the next slide now, here we have the solution. The calculation of the gain is pretty straightforward. We take the proceeds of $850,000 minus the adjusted cost base of $450,000 to arrive at a capital gain of $400,000. Now, the deferral is calculated by multiplying the $400,000 gain by that fraction. The numerator of that fraction is the lesser of the adjusted cost base of the new replacement shares, which is $600,000, or the proceeds of disposition of the old shares, which was $850,000. Therefore, the lesser of those two amounts is $600,000, which is our numerator, divided by our denominator, which is the proceeds of disposition of the old shares, which is $850,000. Now remember, this fraction cannot exceed 1, and in this example, it does not exceed 1. Working through the calculation, we now have the deferred amount of the gain of $282,353. That means the amount of the gain that is not deferred would be reported as a capital gain in the year of disposition, of which 50% would be taxable. The final calculation on the slide here is to calculate the adjusted cost base of the new replacement shares. We simply take the cost of $600,000 and subtract the deferred gain of $282,353. Now this reduces the ACB of the replacement shares, therefore increasing the gain when these new replacement shares are sold sometime in the future. Now in your textbook, do exercise 8.17 at this point to reinforce these rules. So pause the lecture now to complete this exercise before moving on. On the next slide now, we're going to shift our discussion to the replacement property rules now. Often when a taxpayer disposes of capital property, there are tax implications, such as having to recognize a capital gain, or in the case of depreciable property, the inclusion into income of any recapture. If the disposition of such property is unavoidable, for example, in the situation of a fire or flood, these income inclusions could create financial hardship to the taxpayer. Therefore, these replacement property rules were implemented to give taxpayers in these situations some relief. On the slide here, you see that there are two types of disposals that provide such relief. What you also see is that only certain types of asset dispositions qualify for this relief, and also that new property must be acquired to replace the disposed of property within a certain amount of time. Let's look at the first type of disposition listed here, which is a voluntary disposition. Now often this relates to a situation where a business, let's say, is relocating from one location to another new location, and let's say they sell the facilities or building in the old location, and the sale of those facilities or buildings in the old location could result in a capital gain and or recapture. Now, the disposed of assets must qualify as former business property. Now, that essentially is any real property that was used in the business. Furthermore, the replacement property must be acquired within 12 months after the year in which the disposition took place in order for this disposition to qualify for this tax relief. The second type of disposition is an involuntary disposal. Now, often this disposal is a result of theft, fire, natural disaster such as a flood, or expropriation. With an involuntary disposition, any capital property would qualify, and the relief is available provided the replacement property is acquired within 24 months after the end of the year in which the disposition took place. The relief provisions generally allow the taxpayer to eliminate or reduce the capital gain and recapture on the voluntary or involuntary disposal with a corresponding reduction to the capital cost and UCC of the replacement property. Essentially, this defers the inclusion of the capital gain and recapture until the new replacement property is eventually sold. Now, that's just a general description of how this relief provision works. Flipping slides, here is an exercise that will allow you to practice applying the replacement property rules. In this exercise, there is a voluntary disposition of land and building. Assuming that the replacement property occurs within the required time frame answer the questions on the bottom of the slide. Now, if you haven't read through Chapter 8 yet, in particular the replacement property rules, do so now. There are some really good examples that will guide you through the application of these rules. Pause the lecture now to read through the replacement property rules in Chapter 8 and to also complete this practice exercise on the slide here before continuing on to the solution on the next slide. Okay, on the next slide here we have the solution. The capital gain of $25,000 on the disposition of the land and the $50,000 recapture on the disposition of the building are both deferred. The $25,000 deferred capital gain on the land reduces the adjusted cost base of the newly acquired land, and similarly the $50,000 deferred recapture on the building reduces the UCC of the newly acquired building. Now, it's important to note that the adjusted cost base of the building is not reduced as there was no deferred capital gain on the disposition of the old building. On the final slide now, in your textbook, do exercise 8-19 to reinforce these replacement property rules, as these rules are quite complex. Also remember to complete the self-study problems to reinforce the concepts that we've learned in today's lecture. So that's the last topic that I wanted to cover in this online lecture, which brings us to the end of the Chapter 8 online lecture. We will see you in class.